Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems for Chapter 8, the Group B exercises. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing. It is easily remedied by watching someone else work the problems. However, if you don't understand the concepts, that's a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. And also, as a quick aside, and if you watched the last video, you saw me rant and rave for 2 minutes. We're talking about assets, and you end up depreciating assets. All right, so we're at a point in your education where you should understand how to depreciate in several different methods, and you really shouldn't have any questions about it. All right, you should know that material. So I'm not going to go over the theory in each and every exercise for how to do the depreciation. I'm just going to do it. I'm not going to explain the reasons why. The reasons why are covered in previous theory videos, especially those in the math for business/application section of the student community. So if you still don't get depreciation, go back and watch the theory videos in the math, watch the theory videos for in the financial accounting, which basically tells you to go back and watch the math, but it gives you the address and stuff. And from here, we're just going to, keep on moving forward with what is more important, what you're supposed to be learning now, not rehashing old knowledge that you should already have. Okay, so 37. Pembroke Freight purchased a building for $1 million. Right? Notice this is straight line depreciation, and depreciated on a straight line basis over a 30-year period. The estimated residual value was $130. After using the building for 15 years, Pembroke realized that wear and tear on the building would force the company to replace it before 30 years. Starting with the 16th year, Pembroke began depreciating the building over a revised total life of 20 years and increased the estimated residual value of $205. Record depreciation expense on the building for years 15 and 16. So basically what you're doing here is you're when they first buy the building, they are recording it at straight line depreciation. But when they get to year 15, okay, now what they're going to have is they're going to have a change in the useful life. Okay, they're saying instead of 30 years, they're going to depreciate it for 20 years. Okay, so at that point in time, what ends up, so let's just sort of like draw a timeline here. Okay, so this is 0 and this is year 30, right? So we've got year 5, 10, 15, 20, 25, and year 30. So you create the depreciation schedule for the full 30-year period when you first purchase, right? But now, after 15 years, so 15 years have gone by, we're right here. Instead of depreciating it for 30 years, they decide that they're only going to have to depreciate it for 20 years because of the wear and tear. Okay, so there's a change in the useful life. So basically what happens is you're sitting here at year 15 and you look at whatever the book value is at that moment in time, and then you recalculate for the 20 years. All right, so of course, this here, so in essence you have 15 year more of depreciation that needs to now be compressed into a 5-year period. Okay, so that's the concept, the idea behind what you're doing here when you're changing the useful life. Okay, so it says here, revise the total, increase the estimated residual value to 205, and record depreciation expense for years 15 and 16. Right, so first of all, we have to figure out how much we expensed over the first 14 years of the building. So we had $1 million, and it was depreciated on a straight line basis for 30 years, and the residual value was $130,000. Okay, so $1 million minus 130,000 is 870,000, and that's over 30 years. So we're dividing that by 30 years, which gives us 29,000 per year. Okay, so a straight line for the first 15 years, 29,000 times 15 gives us a total amount of 435,000. Okay, so that's how much accumulated depreciation. We've depreciated it over 15 years. Okay, so we're at 435,000. Okay, of accumulated depreciation. So now we're at year 15, and we want to revise our schedule of depreciation. So we take our 1 million, and we have to subtract the 435,000, because that is how much our accumulated depreciation is, in order to get our new book value of 565,000. So that's our book value at the end of year 15, right? Now, and we increased the estimated residual value to 205. So we have to subtract out the 205 for the increase of the residual value. So that gives us 360,000. Okay, and we're only going to depreciate it, since we're in year 15, we're only going to depreciate it to year 20. That's 5 years. So 360 divided by 5 is $72,000 a year. Okay, so that's how much depreciation expense on the building for years 15, 16, 17, 18, whatever. Okay, so that's our revised straight line depreciation amount. Okay, so that's all there is to this particular problem. Okay, the important thing here is, again, when there's a change in useful life, you recalculate you look at whatever the book value is, okay, and then you recalculate by taking out the residual value and how many more years that you're actually going to depreciate it, in order to get a new depreciation expense and per year. Okay, so that's that. If you didn't understand that, pause and rewatch the video, especially the beginning portion, which explains the idea behind it. And if you still don't understand something, then feel free to contact an instructor. But we're moving on. All right, 38. Straight line depreciation, long-term asset disposal. Okay, so it says here, on January 2nd, lighting purchased showroom fixtures for $18,000 in cash, expecting the fixtures to remain in service for 8 years. Lighting has depreciated the fixtures on straight line basis with 0 residual value. Okay, so that's January 2nd, 2014. 8 years, straight line, 0 residual value, paid 18 cash. On August 31st, 2015, right, sold the fixtures for $13,200. Right? Record both depreciation expense on the fixtures for 2015 and the sale of the fixtures on August 31st. Round intermediate calculations to the nearest cent and final answers to the nearest whole dollar. Okay, so it's January 2nd, and we need to calculate the straight line depreciation, right, timeline first, to get an idea where we're sitting at. Here's January 2nd of 2014. Here's 12/31/2014. And here is August 31st, 2015. So what we're looking at here is 8 months, 8 full months in 2015. and a full year in 2013, right? But remember, we're depreciating this out to a full 8 years, so this would end up being 12/31, or actually 1/1/8 would be 2022. Okay, so we'd have 8 more years of depreciation past this date, right? So really, they're depreciating it from here all the way to this period of time, but at this point in time, they decide to sell the fixtures. Okay, and so we have to calculate our straight line depreciation here to begin with, and then we have to take care of the disposal right there. All right, so that's what we have to work through. All right, so the straight line for depreciation is 18,000. Maybe I do it up here. 18,000 in cash. Okay, zero residual value. All right, so, and we're depreciating straight line for 8 years, so we divide by 8, and that's going to give us $22.50 per year. Okay, but in 2015, all right, that is 8 months. So we take the $22.50, all right, and multiply that by 8 over 12, right, and that gives us $1,500 for 2015, right? That's the depreciation amount over 2015. Right, so now we're selling the fixtures for $13,200. So we have to record the depreciation expense for the fixtures in 2015. All right, let me kind of okay. I quickly glanced down, right, because it says here, record both the depreciation expense on the fixtures for 2015 and the sale of fixtures on August 31st, 2015. Okay, so I calculated my depreciation expense for 2015 to be $1,500. So my journal entry should be a debit to depreciation expense for $1,500 and a credit to accumulated depreciation for $1,500. However, the solution shows $1,250 as the amounts, okay? And we know that's wrong, okay? So just be aware that that is a printing error in the solution manual, okay? And the amount should be $1,500, but that's the journal entry that we're going to make to record the depreciation expense for the fixtures for 2015, right? So now we're going to, so go ahead and write that down. Now we're going to figure out what we're doing with the sale. Okay, so we're selling it for $13,200, right? So that's the sale price. Now our cost, our book value of the fixtures, right? So our cost was, or maybe I should do it like this. I should say this is my book value. Okay, it's going to be my cost, which was 18,000. Okay, and I have my less my accumulated depreciation, and that amount is, remember this here was $22.50 per year. Okay, so it's $22.50 for year 2014. Okay, and for 2015, right, it's $1,500. Right, so it's 5,057, $37.50 is what my accumulated depreciation is all the way up to August 31st. So that gives me a book value of $14,250, and we're subtracting that from the 13,200. Okay, so that gives me a loss on the sale of $1,050. Okay, now to record the journal entry, and I'm going to record it kind of, let me erase this, and I'm going to erase this, and as a summary, go over it again, okay? Without showing a lot of the math, just in order to make space to record the journal entry for it. Okay, so I had my sale price of 13,200, right? Now I have to figure out what my book value is, and my book value is the cost, which was 18,000, and the accumulated depreciation, which for the year, remember we had a time, I drew my timeline, right? And I started here at 1/2 and got to 12/31, and this was 2014, right? And then this was 8/31 of 2015. So there's 8 months here, okay? So using straight line, we determined that our depreciation per year was $22.50, right? So that's $22.50 for 2014, and then we calculated the additional 8 months for this period of time, which is 1,500. We add those together, and we ended up with $37.50 for our depreciation, right? So that's where that's coming from, right? So we're going to less our accumulated depreciation of $37.50, which now gives me a book value of $14,250, right? So if we're selling it for 13,200, but our book value is 14,250, that means we're short 1,050, right? So we have a loss on the sale. Okay. Now, as you'll recall, it said, record both the depreciation expense for the fixtures for 2015, which we did. We had debited depreciation expense for 1,500 and credited accumulated depreciation for 1,500. Okay, so that is our entry to record depreciation expense for 2015, right? And again, in the solution manual, it was showing 1250, which was wrong. Okay. Now, as far as recording the sale is concerned, well, when we sell the fixtures, we're going to receive cash, so we're going to debit our cash for 13,200. We have to get rid of our cost, right? So since our cost is a debit to the asset, debit to fixture, we're going to credit our fixture for 18,000. Okay, accumulated depreciation, right, is a credit of 3750, so we have to debit that amount. So we're going to debit accumulated depreciation for 3750. Okay, and the last, debits have to equal credits, right? Debits have to equal our credits, okay, which is the difference, which is our loss, right? So we will debit our loss on sale for 1,050. So now our debits equal our credits, and there's my journal entry. The thing to notice here is that, if you want to try to memorize, if I have a loss, I debit it, and if I have a gain, I credit it, okay? Notice I didn't do that. I didn't memorize. I back into what I need. I sit here and go, and honestly, that's the more appropriate way of thinking through the process instead of trying to memorize what accounts you're going to hit, okay? Because every transaction, every situation is going to be different, and it's easier to sit there and go, okay, number one, I'm going to record what I have, what I'm getting, okay? Then I have to, number two, take the items that are on my books, take them off by reversing them, right? Making the opposite entry for the value of those particular accounts, okay? And then three, what I do is I go and I say, okay, debits equal credits, right? Well, what's the difference between the two, okay? And whatever the difference between those two, between my debits and my credits, whatever the difference is determines whether I actually make a debit or a credit, all right? And I know I'm taking a loss here, so I'm debiting it as a loss on the sale. If this happened to be a gain, let's just say that I sold this for $15,000, right? Well, now I would have a $750 gain, right? Well, my entry over here would be 15,000, right? I'd still have the remainder of these entries, but now the difference between my debits and credits is that I would actually have a credit and I'd have a gain on the sale, all right? And that would be my credit. Yeah, notice that I can memorize a debit for the loss and memorize a credit for the gain. But trust me, after some years, you're not going to remember this, okay? Because you don't do it that often, all right? You're lucky if you do it once every few years, especially if you're an accountant, all right? If you're a business manager, you're never going to, see that happen. So it's easier to, think through the process of how to book the accounts and then back into your loss or your gain to know whether it should be your debit or credit. And by backing into that amount and knowing whether to use the debits equal credits, I can't go wrong. Okay, so take that for what it is. Okay, all right. So that's it for. Let me erase a little bit of this here so that it's a little bit more cleaner, so that you can pause the video and pick up what you need as far as information is concerned. Okay, so go ahead and you can pause the video. If you didn't understand that, definitely go back and pause and rewind the video and watch it again. And if you still don't understand the concept of disposal of the asset, feel free to contact an instructor either via email or telephone.